The current status of the leveraged finance market for middle market private equity health transactions is very strong. There are many alternative lenders with robust amounts of capital sitting out on the sideline ready to do deals. We, in fact, for the right credits for our private equity clients and their portfolio company, oftentimes receive multiple debt proposals prior to a transaction, whether it's an LBO, dividend recap, or other refinancing transaction. And that, of course, leads to a lot better pricing in these deals and more covenant flexibility for the borrowers. In the larger end of the market, the big bank arrangers are still very much out there as well. And it's been interesting to note that some of these alternative lenders have been doing larger and larger deals where they hadn't in the past, and writing larger and larger checks. The most unique deal point in a medical practice transaction is the corporate practice of medicine restrictions that are in place in many states throughout the country, meaning that only medical assets may be owned by a doctor or a friendly physician to the management company, and that management company would be the company that incurs the debt. So this, of course, creates a hole in the guarantee and collateral package that runs in favor of the lenders in these transactions. It's generally been accepted in the market, both in lower middle and upper middle market transactions, that as long as there's a robust management fee agreement that runs to a loan party, therefore supporting the credit of the lenders, that structure is okay, and there will be no requirement of the friendly physician entities to guarantee or otherwise collateralize the debt of the management company entities. Medical service practice companies also oftentimes have JV structures, which can be quite unique, meaning that the management company will oftentimes hold the majority of a joint venture with a doctor or other physician holding a minority interest. And that creates issues with that joint venture guaranteeing the debt that the managed practice company is incurring in connection with an LBO, for example. Therefore, the EBITDA attributable to the joint venture will not count towards financial covenant compliance for the most part, unless those revenues attributable to that majority partner are contributed up into a loan party.